Most Americans follow 40 money rules that sound smart but keep them broke forever. Save for retirement, they say, while inflation destroys purchasing power. Don't take risks, they warn, while playing it safe guarantees financial mediocrity. Work hard and you'll get ahead, they promise, while the hardest workers often stay trapped in paycheck-to-paycheck cycles. Here's the painful reality. Conventional financial wisdom was designed for a different economy, and following it today is like using a map from 1950 to navigate 2024. You've been given broken rules that sound responsible but produce disappointing results. But what if there were 40 different laws based on how wealth actually accumulates rather than how we think it should work? Laws that acknowledge mathematical realities, human psychology, and economic systems as they exist today? If you're tired of following advice that doesn't work and ready for evidence-based principles that do, make sure to subscribe because these 40 laws will challenge everything you think you know about building wealth. Let's start with the foundation laws that everything else builds upon. Number 1. Foundation laws. Building your base. The first 5 laws form the foundation that everything else builds upon, and most Americans get these fundamentals completely wrong from day one. Without a solid foundation, every other wealth-building strategy becomes meaningless because you're constructing your financial future on unstable ground that will eventually collapse under pressure. Law 1. Build assets, not just income streams. Most people focus entirely on increasing their paycheck while completely ignoring whether that money gets converted into wealth-building assets. You can make $100,000 annually and stay broke forever if every dollar disappears into expenses. Or you can make $50,000 and build substantial wealth by systematically converting income into assets that generate returns. Assets are anything that puts money in your pocket over time. Index funds, rental properties, dividend-paying stocks, or businesses that generate cash flow. Income is just the raw material. Assets are the finished product that actually creates lasting wealth. The critical distinction is that income stops when you stop working, but assets can generate money whether you're working, sleeping, or retired. Law 2. Live below a fixed line, regardless of income growth. This might be the most psychologically difficult law because it requires fighting against natural human tendencies toward lifestyle inflation. Choose a monthly spending limit based on your current income. Then when your income grows, keep that spending line exactly where it is and invest the difference instead of upgrading your lifestyle. Your brain will constantly whisper that you deserve to spend more because you're earning more. But wealthy people understand that every dollar spent on lifestyle upgrades is a dollar that can never compound into future wealth. This discipline becomes easier when you reframe it. You're not denying yourself pleasures, you're buying future freedom. Law 3. Wealth building requires ongoing attention, not passive neglect. One of the most dangerous myths in personal finance is that wealth building can be completely passive. While you can automate contributions and choose simple investment strategies, building substantial wealth requires periodic attention, rebalancing, tax optimization, and strategic adjustments based on changing circumstances. This doesn't mean you need to become a day trader or constantly monitor markets. It means reviewing your strategy quarterly, rebalancing annually, optimizing taxes regularly, and staying informed about major changes that might affect your investments. Successful wealth building is more like tending a garden than setting and forgetting. Law 4. Money amplifies but doesn't create happiness. Understanding the psychological relationship between money and happiness prevents destructive spending patterns that sabotage wealth building. Money can solve money problems and provide security, options, and experiences, but it can't fix relationship issues, create self-worth, or eliminate all life challenges. People who expect money to transform their happiness often fall into expensive cycles of trying to buy emotional satisfaction through purchases. This leads to lifestyle inflation, debt accumulation, and the constant pressure to earn more just to maintain spending levels rather than building actual wealth. Law 5. Keep your wealth building private and systematic. Privacy protects your wealth building efforts from social pressure, family requests for money, and the psychological burden of others' expectations about how you should spend your money. When people know you're accumulating wealth, they often feel entitled to opinions about your financial choices or assume you should fund their emergencies and lifestyle desires. More importantly, systematic approaches work better than sporadic efforts. Set up automatic transfers, consistent investment schedules, and regular review periods. Remove emotion and social pressure from the equation by making wealth building as routine and private as brushing your teeth. These 5 foundation laws work because they address both the mathematical and psychological aspects of wealth building, creating sustainable systems that can withstand market volatility, income changes, and social pressures over decades. Number 8. Life strategy laws. Long-term thinking. These final 5 laws address the long-term perspective and personal responsibility required for sustainable wealth building. They focus on consistency over perfection, protection against setbacks, diversification of income sources, continuous self-improvement, and ultimately taking ownership of your financial outcomes regardless of external circumstances. Law 36. Consistent investing beats perfect timing. Most people delay investing while trying to find the perfect moment, waiting for market crashes, ideal economic conditions, or when they have larger amounts to invest. This perfectionist approach typically results in missing years or decades of compound growth, while waiting for conditions that may never arrive, or that they fail to recognize when they do occur. Consistent monthly investing through dollar-cost averaging eliminates the impossible task of timing markets, while ensuring you participate in long-term growth trends. When you invest the same amount regularly, regardless of market conditions, you automatically buy more shares when prices are low and fewer shares when prices are high, which tends to improve average purchase costs over time. The mathematics strongly favor time in the market over timing the market. Even if you had perfect timing and bought at every market bottom over the past 50 years, the difference in returns compared to consistent monthly investing would be much smaller than most people assume. Meanwhile, the stress and complexity of trying to time markets often lead to emotional decisions that hurt rather than help investment returns. Automate your investment contributions so they happen regardless of market news, personal feelings about economic conditions, or other factors that might cause hesitation. This systematic approach removes emotion from investing and ensures consistent progress toward wealth-building goals. Law 37. Emergency funds prevent forced selling of investments. Adequate cash reserves prevent you from being forced to sell investments at unfavorable times due to unexpected expenses, job loss, or other financial emergencies. Without this buffer, temporary setbacks can become permanent wealth destruction when you're forced to liquidate long-term investments during market downturns or personal crises. The psychological benefits of emergency funds often exceed their financial value. Knowing you can handle unexpected expenses without disrupting your investment strategy provides confidence that supports better long-term decision-making. This security allows you to maintain aggressive growth strategies because you're not worried about needing quick access to invested money. Emergency funds should be kept in easily accessible accounts like high-yield savings accounts or money market funds, separate from investment accounts. While this money earns lower returns than investments, its purpose is insurance against forced liquidation rather than growth. Most financial advisors recommend 3 to 6 months of expenses, but the right amount depends on job security, family obligations, and personal comfort levels. Law 38. Build multiple income sources for stability. Relying entirely on employment income creates vulnerability to job loss, industry changes, or economic downturns that can halt wealth-building progress. Developing multiple income streams provides stability that allows continued investing even when primary income is disrupted, and accelerates wealth building when all sources are functioning. Multiple income sources don't necessarily mean multiple jobs. They can include investment dividends, rental property income, freelance work, small business revenue, or other streams that complement rather than compete with primary employment. The goal is to create enough diversification that losing any single source doesn't eliminate your ability to cover expenses and continue investing. Start by leveraging existing skills and knowledge to create additional income before trying to develop entirely new capabilities. If you're skilled at your day job, consider consulting or freelancing in that area. If you have hobbies or interests that others value, explore ways to monetize them without turning them into stressful obligations. Law 39, invest in yourself through continuous skill development. Your earning capacity represents your most valuable asset during wealth-building years, often worth millions of dollars over a full career. Investing in skills, education, and capabilities that increase your earning potential typically provides higher returns than any financial investment, especially early in your career when you have decades to benefit from higher income. This doesn't necessarily mean formal education or expensive programs. Reading relevant books, taking online courses, learning from mentors, practicing new skills, or gaining certifications can significantly increase your market value. The key is choosing skill development that directly relates to increasing your income or creating new income opportunities. Unlike financial investments that can lose value, skills and knowledge become permanent assets that no market crash or economic downturn can eliminate. During uncertain times, people with valuable skills have more options and security than those depending entirely on financial assets or a single income sources. Law 40. Take personal responsibility for your financial future. No external entity, employer, government, family member, or financial advisor cares more about your financial security than you do or has greater incentive to ensure your success. While you can and should seek advice and guidance, ultimate responsibility for your financial outcomes rests with your daily decisions and actions. This responsibility includes educating yourself about personal finance, making consistent progress toward goals regardless of setbacks, and avoiding the victim mentality that prevents taking control of financial circumstances. External factors will always affect your financial situation, but your responses to those factors determine long-term outcomes. Personal responsibility also means acknowledging mistakes quickly and adjusting strategies rather than blaming circumstances or waiting for others to solve your financial problems. Wealth building requires sustained effort over decades, and maintaining motivation requires accepting ownership of both successes and failures. These life strategy laws work because they address the long-term mindset and personal accountability required for wealth building that extends far beyond any specific investment strategy or financial technique. Number 2, crisis and opportunity laws. These 5 laws address how prepared investors can benefit from economic cycles, while unprepared individuals get financially devastated by the same events. Understanding timing, preparation, and decision-making during volatile periods separates those who build wealth from those who lose it during crucial moments. Law 6, economic downturns. Transfer wealth from unprepared to prepared. Economic crises don't destroy wealth. They relocate it from panicked sellers to patient buyers who prepared in advance. During the 2008 financial crisis, millions of Americans lost their homes and retirement savings, while investors with cash reserves purchased quality assets at massive discounts. The same stocks, real estate, and businesses existed before and after the crash, but ownership transferred to those who had liquidity when others needed to sell. Preparation means maintaining cash reserves specifically for opportunities, understanding which assets become undervalued during fear-driven selling, and having the emotional discipline to buy when headlines are screaming disaster. This isn't about predicting exact timing. It's about being ready when inevitable downturns create obvious opportunities. Law 7. Grow income faster than expenses through skill development. Inflation, family growth, and lifestyle changes will continuously pressure your expenses upward over time. If your income remains static while costs rise, the gap eventually forces you to stop investing or go into debt. Making income growth a priority prevents this squeeze and accelerates wealth building. The most reliable way to increase income is by developing marketable skills that command higher compensation. This might mean learning technology skills, improving sales abilities, earning professional certifications, or building expertise that makes you more valuable to employers or clients. Unlike hoping for raises or promotions, skill development puts income growth under your direct control. Law 8. Start compound interest as early as mathematically possible. Time is the most powerful factor in wealth building because compound returns accelerate exponentially over long periods. Starting at age 25 versus age 35 can result in a difference of hundreds of thousands of dollars at retirement, even with identical monthly contributions. The math is unforgiving. Lost time can never be recovered through larger contributions later. This law applies even to small amounts. Investing $100 monthly, starting at age 25, will typically outperform investing $300 monthly, starting at age 40, despite the latter investor contributing more total dollars. The key is establishing the habit and getting money working immediately, rather than waiting for enough to make investing worthwhile. Law 9. Cut losses quickly, instead of defending bad decisions. One of the most expensive psychological traps is continuing to invest money in failing ventures, because you've already invested so much that walking away feels like admitting defeat. This sunk cost fallacy destroys more wealth than most people realize because it prevents capital from being redirected to better opportunities. Whether it's a losing stock position, a struggling business, or an expensive purchase that isn't providing value, the money already spent is gone, regardless of future decisions. The only relevant question is whether continuing makes financial sense based on current information, not past investments. Pride is expensive, but humility preserves capital for better opportunities. Law 10. Never invest in what you don't thoroughly understand. Complex investment products, trendy opportunities, and anything requiring explanations filled with jargon should be avoided until you genuinely understand how they generate returns and what risks are involved. If you can't explain an investment to someone else in simple terms, you don't understand it well enough to risk your money. This principle protects against fraud, unsuitable investments, and products designed to benefit sellers more than buyers. Many financial disasters result from people investing in things they didn't understand because they trusted someone else's recommendation or got caught up in market enthusiasm. These preparedness laws work because they acknowledge that markets are cyclical. Opportunities require readiness, and sustainable wealth building demands both patience and decisive action at crucial moments. Number 3. Investment laws. Smart money management. These 5 laws address how to deploy your money strategically to build wealth while avoiding common investment mistakes that destroy financial progress. Smart money management requires understanding inflation, avoiding emotional crowd behavior, embracing boring consistency, and using debt strategically rather than destructively. Law 11. Cash loses purchasing power. Invest in inflation-fighting assets. Keeping large amounts of money in savings accounts earning 1 to 2% interest while inflation runs 3 to 4% annually guarantees you'll lose purchasing power every year. Your bank balance might grow nominally, but your money buys less over time. This safe approach is actually a guaranteed way to become poorer slowly. After establishing an emergency fund covering 3 to 6 months of expenses, additional cash should be invested in assets that historically outpace inflation. Diversified stock market index funds, real estate investment trusts, REITs, or inflation-protected treasury securities, TIPS. The goal isn't eliminating all risk, it's balancing the guaranteed loss from inflation against the potential volatility of growth investments. Quality businesses tend to raise prices with inflation, making their stock values inflation-resistant over long periods. Real estate often appreciates with inflation while providing rental income that can increase over time. These assets aren't risk-free, but they offer better long-term purchasing power protection than cash. Law 12. Avoid lifestyle inflation that forces desperate decisions. Taking on fixed expenses that consume most of your income creates financial fragility that forces poor decisions during emergencies or market downturns. When your monthly obligations approach your income, you have no flexibility to handle unexpected expenses, take advantage of opportunities, or maintain investments during temporary setbacks. High fixed costs force people to sell investments at bad times, accept unsuitable jobs, or go into debt for normal life events. This financial stress makes wealth building nearly impossible because you're constantly reacting to immediate pressures rather than implementing long-term strategies. The solution is keeping fixed expenses well below income even as earnings grow, maintaining financial flexibility that allows strategic decision-making rather than desperate reactions. This might mean driving older cars, living in modest housing, or avoiding expensive monthly commitments that lock you into high-pressure financial situations. Law 13. Think independently. When crowds panic or celebrate, market psychology drives most individual investors to buy when prices are high, during optimism, and sell when prices are low, during fear, which is the exact opposite of successful investing. Following crowd emotions typically results in buying expensive assets and selling cheap ones. Independent thinking doesn't mean being contrarian for its own sake. It means making decisions based on your analysis and long-term strategy rather than current market sentiment. When everyone is panicking about market crashes, ask whether the underlying businesses you own have actually become less valuable, or if fear is creating temporary price distortions. During market euphoria, resist the pressure to chase trending investments or abandon disciplined strategies because this time is different. History shows that following crowd emotions consistently produces below-average returns, while staying disciplined during emotional extremes creates wealth-building opportunities. Law 14. Extraordinary results come from ordinary habits. Repeated wealth building isn't about finding secret strategies or making brilliant moves. It's about consistently doing simple things that most people won't do because they seem boring. Investing $500 monthly in broad market index funds, automatically reinvesting dividends, and ignoring short-term market noise creates more wealth than sporadic attempts at stock picking or market timing. The mathematics of compound growth reward consistency over intensity. Small amounts invested regularly outperform large amounts invested sporadically because compound returns accelerate over time. Most people fail at wealth building not because they lack knowledge, but because they lack consistency. Success comes from automating good financial habits so they happen regardless of motivation, market conditions, or life circumstances. Set up automatic transfers, automatic investments, and automatic reinvestment of dividends, then maintain those systems for decades, while others chase new strategies. Law 15. Use debt strategically for cash-flowing assets. Only debt accelerates both wealth building and wealth destruction, depending on how it's used. Borrowing money to purchase assets that generate more cash flow than the interest payments can multiply returns, while borrowing for consumption or speculation typically leads to financial problems. Strategic debt means fixed-rate mortgages on rental properties where rent exceeds all expenses, business loans for proven revenue-generating activities, or leveraging appreciating assets when interest rates are favorable. The key is ensuring cash flow covers payments with adequate safety margins for vacancies, repairs, or economic downturns. Avoid debt for vehicles, vacations, consumer goods, or speculative investments where payments aren't covered by the asset's income generation. These uses of debt create ongoing expenses without corresponding income, making your financial situation more fragile rather than stronger. Number 4. Tax and system laws, working within rules. These 5 laws focus on optimizing your wealth building within existing legal and social systems while maintaining balance and avoiding common strategic mistakes. Understanding how to work efficiently within established rules can significantly accelerate wealth building without taking unnecessary risks or sacrificing important life priorities. Law 16. Learn legal tax optimization strategies. Taxes represent one of your largest lifetime expenses, often exceeding housing costs over a full career. Understanding legal strategies to minimize tax burden can add thousands of dollars annually to your wealth-building efforts. This isn't about aggressive tax avoidance or questionable schemes. It's about using established rules that favor savers and investors. Maximize contributions to tax-advantaged retirement accounts like 401ks and IRAs, which reduce current taxes while allowing investments to grow tax-deferred. Understand the difference between tax-deferred and tax-free accounts, traditional versus Roth, and choose based on your current and expected future tax rates. Take advantage of health savings accounts, HSAs, which offer triple tax benefits, deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. For business owners, legitimate business expenses can significantly reduce taxable income when properly documented. Real estate investors can benefit from depreciation deductions and 1031 exchanges. The key is working with qualified tax professionals who understand current rules and can ensure compliance while maximizing legal benefits. Law 17. Prepare for rare opportunities with cash reserves. Exceptional wealth-building opportunities appear irregularly during market dislocations, economic downturns, or industry disruptions. Having liquid capital available during these periods can accelerate wealth building by years or decades, but only if you're prepared when opportunities arise. This means maintaining cash reserves beyond your emergency fund, specifically for investment opportunities. When quality stocks crash 50% during market panics, real estate becomes available at significant discounts, or businesses need capital during economic stress. Prepared investors can acquire assets at prices unavailable during normal times. The challenge is maintaining discipline to keep these reserves available rather than deploying them prematurely during smaller opportunities or market volatility. This requires accepting the opportunity cost of holding some cash, earning low returns, while waiting for exceptional circumstances that may take years to develop. Law 18. Keep financial goals private from casual critics. Sharing your wealth-building plans with family, friends, or coworkers often generates more obstacles than support. People project their own financial limitations, fears, and misconceptions onto your goals, creating doubt and social pressure that can derail disciplined strategies. Well-meaning relatives might discourage investment risks they don't understand. Friends might pressure you to spend money on social activities that don't align with your priorities. Or coworkers might create expectations about your lifestyle that conflict with your wealth-building discipline. Work with qualified mentors, financial advisors, or like-minded individuals who understand wealth building, but avoid discussing specific financial goals or strategies with people who haven't demonstrated success in these areas. This privacy protects your motivation and prevents external opinions from influencing important financial decisions. Law 19. Focus 80% of effort on 20% of highest impact activities. The Pareto principle applies strongly to wealth building. Most of your financial progress will come from a small number of high-impact decisions and habits. Identify which activities produce the greatest returns on your time and energy, then concentrate your efforts there while eliminating or automating lower-impact tasks. For most people, the highest impact activities include increasing income through skill development, maintaining high savings rates through automated systems, and consistent investing in low-cost diversified funds. These boring fundamentals produce more wealth than complex strategies, active trading, or constantly researching new investment opportunities. Track which activities actually move you toward financial goals versus those that feel productive but don't create measurable progress. Eliminate time spent on financial entertainment, excessive research, or strategies that don't match your situation and risk tolerance. Law 20. Balance wealth building with health and relationships. Wealth building shouldn't consume your life or damage important relationships and personal well-being. Money amplifies who you are. It doesn't create happiness, health, or meaningful connections that weren't already present. Sacrificing health, family time, or personal integrity for financial gain often proves counterproductive in the long run. Maintain boundaries around work hours, prioritize sleep and exercise, and invest time in relationships that matter. Build character and skills alongside financial assets, because wealth without wisdom, health, or relationships often creates more problems than it solves. The goal is creating sustainable wealth-building habits that enhance rather than detract from overall life satisfaction. Financial independence should provide more time and options for what matters most, not less. Number 5. Banking and credit laws. Financial system basics. These 5 laws address how to work effectively within the banking and credit systems that form the foundation of modern financial life. Understanding how these systems operate and using them strategically can significantly impact your wealth-building efforts, while misusing them can create obstacles that take years to overcome. Law 21. Savings accounts, park money, investments, grow money savings accounts serve an important but limited purpose in wealth building. They provide safe, liquid storage for emergency funds and short-term financial goals. However, expecting savings accounts to build wealth is like expecting a parking garage to grow crops. The interest rates on most savings accounts barely keep pace with inflation, making them wealth preservation tools rather than wealth creation tools. Once you've established an adequate emergency fund, typically 3 to 6 months of expenses, additional money should be directed toward investments that offer higher long-term returns. This might include low-cost index funds, diversified ETFs, or other investments appropriate for your timeline and risk tolerance. The key is understanding the different roles. Savings accounts provide security and liquidity for money you need access to quickly, while investments provide growth potential for money you won't need for several years. Both serve important functions, but they shouldn't be confused or used interchangeably. Law 22. Understand how banking and credit systems actually work. Banks profit by paying you small amounts of interest on deposits, then lending that money to borrowers at higher interest rates. Understanding this basic business model helps you make better decisions about where to keep money and how to use credit products effectively. Most money in the economy exists as digital entries in banking systems rather than physical cash. When banks make loans, they create new money in the system, which is why understanding credit and debt matters for your personal financial strategy. This system rewards people who understand how to use credit responsibly while penalizing those who become trapped in high-interest debt cycles. Educational resources about banking, credit scores, and financial systems can help you navigate these relationships more effectively. Understanding terms, fees, and how different products work protects you from costly mistakes and helps you identify opportunities to optimize your banking relationships. Law 23. Borrow only when interest rates favor asset appreciation. Strategic borrowing can accelerate wealth building when the cost of borrowing is lower than the expected returns on assets you purchase with borrowed money. This typically applies to mortgages on appreciating real estate, business loans for revenue-generating activities, or other situations where the asset produces income that exceeds the borrowing costs. However, this strategy requires conservative assumptions about income, expenses, and asset performance. Interest rates, vacancy rates, maintenance costs, and economic downturns can all affect the viability of leveraged investments. Only borrow for assets when you can handle payments, even if circumstances become more challenging than expected. Avoid borrowing for consumption, speculation, or any situation where the borrowed money doesn't generate income to service the debt. Personal loans for vacations, credit card debt for lifestyle expenses, or borrowing to invest in volatile speculations typically create financial stress rather than wealth. Law 24. Build credit score to access cheaper capital. Your credit score significantly affects the interest rates you'll pay on mortgages, business loans, and other borrowing that might support wealth building. The difference between excellent and poor credit can cost tens of thousands of dollars over the life of a mortgage, making credit management an important wealth-building tool. Building strong credit requires consistent on-time payments, keeping credit utilization low, typically under 30% of available limits, maintaining older credit accounts, and avoiding excessive credit inquiries. These habits take time to establish but provide long-term benefits through access to better borrowing terms. Monitor your credit reports regularly for errors and address any problems promptly. Consider the long-term value of maintaining excellent credit, even if you don't currently need to borrow money, as future opportunities may require access to capital on favorable terms. Law 25. Treat credit cards as tools, not lifestyle enablers. Credit cards can provide valuable benefits, including purchase protection, rewards programs, and convenience, but only when used responsibly. The key is paying balances in full every month to avoid interest charges that typically range from 18 to 29% annually, rates that make wealth building mathematically impossible if you're consistently paying them. If you cannot reliably pay credit card balances in full monthly, the safer approach is to use debit cards or cash until you develop better spending discipline. The convenience and rewards of credit cards are meaningless if they enable overspending that creates debt cycles. Use credit cards strategically for planned purchases while maintaining strict payment discipline. This approach can provide benefits while building positive credit history, but it requires honest self-assessment about your ability to avoid the psychological traps that lead to credit card debt. Number 6. Lifestyle laws. Living strategically. These 5 laws address how your lifestyle choices and investment preferences can either accelerate or sabotage your wealth-building efforts. Strategic living means making conscious decisions about commitments, habits, and business models that align with long-term financial goals rather than short-term impulses or social pressures. Law 26. Avoid major financial commitments before building a foundation. Taking on large fixed expenses before establishing financial stability creates pressure that forces poor long-term decisions. Expensive car payments, high rent in prestigious neighborhoods, or lifestyle commitments that consume most of your income leave no room for wealth building and make you vulnerable to any income disruption. This financial pressure often traps people in jobs they dislike because they can't afford the income reduction that might come with career changes, entrepreneurship, or skill development opportunities. When most of your income goes to fixed obligations, you lose the flexibility that enables strategic financial decisions. The foundation should include an emergency fund, manageable fixed expenses, ideally under 50% of take-home pay, and automated savings before taking on major lifestyle upgrades. This creates the financial breathing room necessary for long-term wealth building and provides options during unexpected circumstances. Build your foundation first, then upgrade lifestyle elements gradually as your wealth-building systems become established. This patience prevents lifestyle inflation from consuming income increases and maintains the flexibility to take advantage of opportunities that require financial resources or income flexibility. Law 27. Eliminate expensive habits that compound against you. Small recurring expenses might seem insignificant individually, but they compound over time just like investments, except they compound against your wealth instead of for it. Daily coffee purchases, frequent takeout meals, subscription services you rarely use, or other habitual spending can easily total hundreds of dollars monthly. Calculate the lifetime cost of expensive habits by projecting monthly expenses over several years. Then consider what that money could become if invested instead. A A $200 monthly habit costs $2,400 annually, which invested at 7% returns could become over $150,000 over 30 years. This isn't about eliminating all enjoyment or living like a monk. It's about being conscious of which expenses provide genuine value versus those that happen automatically without consideration. Focus on habits that damage both wealth and health simultaneously, such as expensive convenience foods that cost more than home cooking while providing inferior nutrition. Replace expensive habits with alternatives that support your goals. Instead of expensive gym memberships you rarely use, develop home workout routines. Instead of daily restaurant meals, invest time in meal planning and cooking skills that save money while improving health. Law 28. Choose experiences over purchases for happiness. Research consistently shows that spending money on experiences provides more lasting satisfaction than purchasing material goods. Experiences create memories that appreciate over time, while possessions typically lose both financial value and emotional impact relatively quickly. This principle supports wealth building because experiences can often be enjoyable without being expensive. Hiking, cooking with friends, reading, learning new skills, or exploring local attractions can provide significant enjoyment at minimal cost, while expensive purchases often provide temporary satisfaction, followed by the pressure to upgrade again. When you do spend money on experiences, choose those that align with your values and goals. Educational experiences that develop skills, travel that broadens perspectives, or activities that strengthen important relationships can provide lasting value beyond immediate enjoyment. Avoid the trap of expensive experiences that don't match your interests just because they seem impressive to others. Social media creates pressure to pursue costly experiences for their appearance, rather than their genuine value to your life and development. Law 29. Invest in simple, predictable business models. Whether choosing investments or building businesses, favor simple models with predictable revenue streams over complex ventures with uncertain outcomes. Businesses that provide essential services, have recurring customers, and operate with understandable economics tend to be more stable and easier to evaluate than complex or highly speculative opportunities. Simple doesn't mean easy, it means comprehensible. A rental property generates income through rent payments that you can calculate and predict reasonably well. A dividend-paying utility stock provides returns through services that customers need regardless of economic conditions. These investments may not be exciting, but they offer predictable performance you can plan around. Complex investment products, businesses with unclear revenue models, or opportunities requiring specialized knowledge you don't possess introduce unnecessary risks and make it difficult to assess whether your strategy is working effectively. Law 30. Understand the power of brand loyalty and customer retention. Strong brands create customer loyalty that provides sustainable competitive advantages and predictable revenue streams. When investing in stocks or building businesses, focus on companies that customers choose repeatedly rather than those competing primarily on price. Brand loyalty reduces marketing costs, enables premium pricing, and creates more predictable cash flows compared to businesses where customers make purely transactional decisions. Companies with strong customer retention typically provide more stable investment returns and business opportunities. If building your own business, invest time and resources in creating genuine value and positive customer experiences, rather than just competing on price. Loyal customers provide referrals, repeat business, and feedback that helps improve your offerings over time. These lifestyle laws work because they recognize that wealth building happens within the context of daily life decisions, and aligning your lifestyle choices with your financial goals creates consistency that accelerates progress over time. Number 7. Investment strategy laws. These 5 laws address sophisticated investment approaches that can enhance returns and reduce risks for investors who have mastered the basics. Advanced principles require understanding market psychology, systematic decision-making, and portfolio construction strategies that balance growth potential with risk management over long investment horizons. Law 31. Prioritize dividend-paying assets for cash flow. Dividend-paying investments provide tangible returns that arrive regardless of market volatility, creating psychological and financial benefits that pure growth investments cannot match. Regular dividend payments provide evidence that your investments are actually working, which helps maintain discipline during market downturns when stock prices might be declining. Quality dividend-paying companies typically have established business models, predictable cash flows, and management teams focused on returning value to shareholders rather than pursuing risky growth strategies. This doesn't guarantee success, but it often indicates financial stability that can weather economic challenges better than companies that reinvest all profits into uncertain expansion plans. However, dividend focus requires careful analysis because high dividend yields can sometimes indicate distressed companies that may cut payments during difficulties. Sustainable dividends come from companies with strong competitive positions, reasonable payout ratios, typically under 60% of earnings, and histories of maintaining payments through various economic cycles. Consider dividend growth investing, which focuses on companies that consistently increase their dividend payments over time. These companies often provide both income and inflation protection, as growing dividends typically reflect growing business fundamentals. Reinvesting dividends automatically purchases additional shares, accelerating compound growth over long periods. Law 32. Patience beats panic in investment decisions. Market volatility creates emotional pressure to make decisions based on fear or greed, rather than rational analysis. Successful long-term investing requires developing the discipline to maintain strategy during both market euphoria and panic, recognizing that temporary price movements don't necessarily reflect changes in underlying asset values. This patience must be systematic rather than passive. Set clear criteria for when you'll buy, sell, or rebalance investments before emotional situations arise. Having predetermined rules helps maintain objectivity when market movements trigger psychological responses that typically lead to poor timing decisions. During market downturns, resist the urge to sell quality investments at discounted prices. During market bubbles, avoid the pressure to abandon disciplined strategies to chase trending investments. Both emotional extremes typically result in buying high and selling low, which destroys wealth over time. Patience also applies to individual investment selections. Quality businesses may take years to reflect their fundamental value in stock prices, but patient investors often get rewarded for maintaining positions in companies with strong competitive advantages and competent management teams. Law 33. Fear creates buying opportunities for prepared investors. Market fear typically creates temporary price distortions where quality assets trade below their intrinsic values due to emotional selling rather than fundamental deterioration. Prepared investors can benefit from these dislocations by purchasing quality investments at prices unavailable during normal market conditions. This requires maintaining cash reserves specifically for opportunities and having predetermined criteria for what constitutes attractive valuations. Without preparation, you'll either lack capital when opportunities arise or make poor selections during emotional market conditions. Focus on understanding which assets become genuinely undervalued during fear-driven selling versus those that decline due to legitimate fundamental problems. Market-wide sell-offs often create opportunities in quality companies that get caught up in general pessimism, while company-specific problems may indicate genuine issues that justify lower prices. Law 34. Take profit systematically, not emotionally. Systematic profit-taking prevents the common mistake of holding winning investments too long due to greed or hope that gains will continue indefinitely. Establish predetermined criteria for reducing positions when investments reach target valuations or represent excessive portions of your portfolio. This doesn't mean trying to sell at perfect tops. It means taking some profits when investments have performed well to reduce risk and redeploy capital to other opportunities. Systematic approaches help maintain discipline during both euphoric markets that encourage holding everything and fearful markets that encourage selling everything. Consider rebalancing strategies that automatically take profits from outperforming investments and redirect money toward underperforming assets, maintaining target allocation percentages while forcing systematic profit-taking and loss-cutting behaviors. Law 35. Diversify enough for safety. Concentrate enough for impact. Effective diversification reduces portfolio risk without eliminating growth potential. But over-diversification can limit returns to mediocre levels. The goal is owning enough different investments to protect against individual failures, while concentrating enough in your best opportunities to generate meaningful wealth building. For most investors, broad market index funds provide appropriate diversification across hundreds or thousands of companies without requiring individual stock analysis. This approach captures overall market returns while minimizing the risk of individual company failures destroying your portfolio. However, investors with expertise in specific areas might benefit from concentrating larger portions of their portfolios in sectors or companies they understand deeply, while maintaining broad diversification for the majority of their holdings. This approach balances the potential for above-average returns with protection against major losses. These advanced principles work because they address the psychological and systematic challenges that separate successful long-term investors from those who let emotions drive their investment decisions. These 40 laws work because they're based on mathematical principles and documented human behavior patterns, not marketing hype or get-rich-quick promises. Building real wealth requires 10 to 20 years of consistent application across foundation building, crisis preparation, smart investing, system optimization, lifestyle discipline, and personal development. The reality is that most people will read these laws, feel motivated briefly, then return to old habits within weeks. Sustainable wealth building demands implementing 3 to 5 laws consistently, rather than attempting all 40 simultaneously and burning out. Which 3 laws will you commit to implementing over the next 90 days? Comment laws numbers with your specific choices. This accountability helps both you and other viewers see what's working for people in similar situations. If this provided a realistic framework for wealth building without unrealistic promises, subscribe for more evidence-based financial content that prioritizes long-term results over short-term motivation. Remember, this is educational content only, not personalized financial advice. Always consult qualified professionals before making significant financial decisions, and never invest money you can't afford to lose completely.